Good afternoon, ladies and gentlemen. It's wonderful to be back here on the GLS stage for our evening plenary sessions. And as I said, we couldn't have asked for a better start than to start with Mr. K.V. Kamath, somebody who knows India, somebody who's been deeply associated with India's financial services sector, and somebody who is and always will be a perma bull on India. Mr. Kamath, thank you very, very much for joining us here at the Global Leadership Summit, sir.
Thank you, Shireen.
Well, let me get started, sir, with the sector that you've, of course, been most involved with India's banking sector. And today, as is very, very evident and very clear over the last few years, we've seen India's banking sector revive, clean up its balance sheet, emerge much stronger. In fact, State Bank of India crossed 2 milestones yesterday, crossed the $100 billion mark in market capitalization, but also crossed the 100 trillion rupee mark in business. And I was asking C.S. Sethi, the chairman of State Bank of India, what's the aspiration from here? And he said to be amongst the top 10 banks globally in the next 5 years. Mr. Kamath, that is an audacious aspiration and an audacious ambition. Do you think that India's banking sector is poised to break into the top 10?
Yeah. Firstly, my compliments to State Bank on achieving these 2 milestones. My answer is certainly yes, for a simple reason. This would not have been possible if we are not growing at the pace we are growing. And it would not have been possible if the banking sector was systemically not as strong as it is today. So given these 2 things, we will reach the aspirations set by State Bank of India and indeed other bankers. Again, sometimes I look back to see what I can see ahead. And when I look back at, say, China, circa 2000-2005, that period, is when the bank started bulking up. And that's where you could see the pace of, I would say, growth go into double digits. So I think our steady growth of 7% or that range should take us to that sort of bulking in the next few years.
And yes, SBI has also upped its credit growth guidance to between 12 and 14% for the year. But, in terms of the next stage of reforms for the banking sector, and to talk specifically about public sector banks, Mr. Kamath, the expectation is that we're now going to see the next wave of consolidation as far as public sector banks is concerned, because the government wants not just world-class banks, but also world-sized banks, so bigger banks. Do you believe that consolidation is the answer?
I entirely agree with the government's path for a very simple reason. Historically, consolidations have happened, at least in the Indian context, when things were not good. I think this is the first time when things are good and you're consolidating. And what does consolidation get you? It gets you scale and gets you bulk and gets you, I would say, efficiency of operation. And all these are critically important today, and even more so when you're talking of, I would say, a technological revolution that you're all going through. So this is absolutely the correct move at this point in time.
Correct move at this point in time. Another possible move is the consideration to enhance the FII limit for public sector banks, which is capped at 20% currently, to 49%. The PSB view is that this gives private sector banks an unfair advantage when we talk about FII participation. It doesn't actually dilute equity at all. Why not do it?
I entirely agree. The playing field has to be level. Why should there be a playing field which is different for private banks and different from public sector banks? Over the last whatever number of years you want to count, the public sector banks have played a major role in the banking system, and I don't see that changing. So you need to have a level playing field going forward.
While we level this playing field, so to speak, Mr. Kamath, what gives you the most confidence about what we're seeing in the banking sector and in the larger financial services sector? When we last spoke, you said banks don't need to worry about other banks. They need to be worried about what's happening on the fintech side. They need to be worried about tech companies who are also doing banking. As you look at the landscape and how much it's changed today, where do you find confidence and where are your concerns?
Yeah, my biggest confidence is the fact that, what gives me the biggest confidence is the fact that the bank balance sheet is clean. If we were having this conversation in a situation where bank balance sheets are not clean, profitability is not at healthy levels, then we would have probably gone in a different direction. So banks are strong, and banks can today compete. So they have capital, they have people, they have understood how to use technology. So they have all the elements. What is required is to understand how the new player, what I call the new any fintech or any player which is not a bank but is agile in using technology, how are they acting, and make sure that you keep pace with them. That is a challenge. So that challenge exists, but I think it's a challenge you can overcome. And that's where I think in another session that I was having with one of your colleagues, I said that banks are spending money, but they need to spend it where in a competitive sense it is most productive.
Which means to actually acquire capabilities, to acquire some of these new cores that you spoke of?
No, not necessarily. What I mean is to put in the right technology that is appropriate for today, rather than do more of the same thing that we were all doing over the last few years.
Yes, so to disrupt yourselves using technology. Yeah. But what we've also seen happen over the last few years is the retail participation in the India equity story has picked up very significantly post-COVID, and it's been a very secular rise across the nation, fueled by domestic participation and domestic capital. Has that surprised you? And given the unlock that we've now seen happen, what is the kind of headroom for growth that you foresee?
No, I think the India story is driven by two or three things. I think firstly it is the long runway that we have. So that gives you headroom. If you did not have a 25-year growth runway, and why do we have that? Because I would think most of India is still to be built. That act of building itself provides the momentum. Again, you look at how growth has happened in other domains in the last 30, 40 years or 50 years. Japan first, Southeast Asia, tiger economy, Southeast Asia, China. You see the transformation journey starts with building what you don't have. And that itself propels you to a status where the next leap becomes easier. I think we are well on that journey. So that headroom we have. Then comes the question that is often asked, where is the capital?
Yes.
I think now we have clearly shown that question has been asked for now at least 30 years that I have been in banking. Not the 50 years I was in development banking, but the 30 years that I have been in banking, that question has been asked, but where is the capital? I think the India story is what I would call a very measured growth. The government has always been careful to make sure that we grow at a pace which we have the ability to support. But today, I think we can grow at a faster pace because the access
What is a faster pace, sir?
I would say that we should actually aspire for a 10% growth rate. And then we will achieve 8%. So that's what we need to do. And also, and I'm very happy that the index is being reset of, say, industrial production or various indices, because we will then have a better picture of at what pace are we really growing. I would think that we are probably growing a little faster than what we all assume.
Than what the numbers reflect at this point in time. Yes, and that review is, of course, underway at this point in time for metrics that measure inflation as well as growth. But, Mr. Kamath, you talked about this aspiration of getting to 10%, and you said if we aspire for 10, we'll probably get 8. If you were to look at the landscape today and the measures that have already been taken, this year, the effort seems to be to boost consumption. We saw the income tax cuts, and we've just seen the indirect tax cuts by way of the GST. What next would you prioritize to really get to that 8 to 10% number?
See, I think we have to get on to what I call a virtuous cycle. Consumption is one part of that virtuous cycle. Investment is the other side. And the question could be, where do you invest? As I said, that's where the long horizon comes in. So you've got enough to invest. And as GDP goes in, aspirations change. That's the third part of it. So this keeps the momentum going. Now, again, historically, we would, that rhetorical question that I said, but where is the money to fund this? And that question has now been answered. Now, a classic case that I would use to say how this got addressed is NHAI. NHAI, we used to I'm talking of NHAI, say 10 years back or so. How will NHAI fund all the highway needs of this country? Just didn't seem possible because it would otherwise take a larger and larger portion of the budget. But today, that issue is a non-issue. Because what they have already put in place is now getting tolled properly.
Yeah.
And that tolled road is now you create an INVIT out of it, and you have a funding which was not thought of or could not even have been conceived of 5-10 years back. So basically, we are creating new avenues to fund ourselves, and all this without necessarily looking at foreign capital. If I look at last 5 years, most of our growth has come through domestic capital, unlike most other domains. So we have got a lot of levers to push. We are on that virtuous cycle, and I think we will keep pumping at a good pace.
You talked about where is the capital and new avenues to actually find that capital. I was just speaking with the Niti Aayog CEO, the last session at the Global Leadership Summit, and he talked about InvITs, for instance, as a means for us to be able to raise capital. REITs is another example. What next in terms of instruments that you believe could be relevant as we look at capital and growth?
See, InvITs and REITs. InvITs is what I meant when I talked of NHAI. And REITs is now becoming the default structure for real estate. These are areas which you never thought of that had a solution, but we have found a solution. I would think that there is, both InvITs and REITs, we are just at the start of it, at the start of the process. And that could become a huge source of funding for institutions. Now, the capital market is itself a large source of funding. So you mentioned about equity, the cult of equity and people putting money into equity. People also have other savings products which require debt-type instruments to, at the back, other end of it. So whether it is insurance, whether it is pension, a large part of, that will have to be invested through debt instruments. Those debt instruments are accessed through the capital market by people who grow India. So there's another virtuous cycle that is getting built there. So to me, you got banks, you got the capital market, and you got this structure under which you create an InvIT. Gets funded through the capital market. So you, from just maybe a unitary source of financing 10 years back, today you've got multiple sources. So that's why I said that funding is not going to be a problem. It is going to be, who does it best and how do you do it best? Because the other question that you asked, banks, growth of banks. We have not yet explored what will be demand for bank credit from the retail sector as India goes from 5 trillion to 10 trillion. Nobody has estimated it. I have not seen a single number.
What is your number, sir?
My number is just look around elsewhere as to what is it as a percent of GDP. And then you will get an answer. I don't want to give an answer. Some homework is required. Look at what is that, retail debt to GDP in 3 or 4 domains where we are. It's at least twice of where we are. At least twice of where we are. So that itself gives you demand for a long time. At the same time, corporate demand from banks may not be what it is. So these shifts will happen because the capital market is providing those monies. Companies are better leveraged, so they don't need to borrow as much.
Yeah.
They don't need to borrow short term. Long term, they'll borrow from the capital market. So the banks will have a place in terms of providing working capital and shorter tenor, which is appropriate to their funding profile and retail credit. Whereas the capital market will provide the rest of it. So we have what I call a system which is in harmony, which will provide for this next journey from 5 to 10. Of course, there's another journey, 10 to 20. And it's not going to be that far behind. 5 to 10 is going to take 6 to 7 years. The 10 to 20 journey is on us very, very quickly thereafter.
Very quickly thereafter, since we're talking about the capital markets, 2 questions. Something that we've seen through 2025, the emergence of India, what is now being called as the IPO factory of the world. You talked about some of these new cores in the fintech space. We've seen 1 or 2 of them list, and we've got listings lined up in the fintech space as well. What do you make of this move of these startups, these new age companies to the Indian equity markets, and what that signals and what it could potentially mean in the medium to long term?
I would look at it in a very positive construct, and that is that the governance of all these companies that are coming to the market is now going to improve. Not that they were not well governed, but they will now be subject to market discipline. And that itself will strengthen the core of what is happening in India. So these companies will now be an integral part of the growth engine of the country. in a way that you expect it to be. And that's for the good. So I welcome all the new issues that are coming on. As long as, before the issue was made, it has been properly vetted and properly brought to the table, as it were.
The valuation debate is on as well, sir. I mean, not just as far as IPOs are concerned and IPO pricing, but also on valuations as far as Indian stocks are concerned. Are we too expensive? Is that why we're not actually seeing FPIs come in? Or is it more the capital gains issue along with the global environment? What do you make of the reluctance of FPIs to enter the Indian market at this point?
Actually, at this point in time, if you're trading at around 22, do you have space for these foreign investors? You'd have created a market which is too hot to handle. I think if you're finding the market, just now priced a little higher than where people might have been comfortable, I'm comfortable with this price because for
you are comfortable.
Yeah, for a growing economy, this is the right price. There could be individual issues which are not at the right place, and that's exuberance. But overall, the market is not at a price which is too high and dangerous. So I'm comfortable with this price.
Are you also comfortable with AI valuations and what we're seeing happen globally? Of course, that's not part of the India story, at least at this point in time. But what do you make of the AI boom? And do you believe that this will perhaps be the one area where we need to move much faster, given what's happening?
Shirin, if you look back at, same sort of dialogue was going on during the dot-com boom. Most of the people here would have been too young to know about that. I've lived through that, the sort of hype that happened. And there are companies which actually listed on NASDAQ saying that I have no business plan, I don't know whether I'll be in business, and I don't know when that would be if I get into business.
But I'm a dot-com company.
And the dot-com company, listed. So those are the sort of tales that you heard. So things are not that bad today, and you can clearly see some of the benefits. But to me, at this point in time, a bit of the hype has to die down. And then you will really understand what exactly do these companies do and how do they bring value to the table. So I will let it ride. And in a way, our not being in the midst of it in India is a good thing. That is, these companies, we should adapt to the extent that we need to adapt. I'm saying we are not late to the party for a very simple reason. You take it, any technology that has come in the last 25 years, being late to the party has been always good. Because you could get in and use that technology when the cost of the technology had probably come down to probably 20-25% at what it was at the beginning. So I think we lose nothing by waiting out 6 months, a year and a half, 2 years, and joining the bandwagon when costs have come to what I call reasonable levels. So, and we have seen that happen in every single area.
So don't suffer from FOMO.
I'm not worried at all about FOMO. Better be out of it at this point in time.
Better be out of it at this point in time. One of the concerns, though, that was again shared by the Niti Aayog CEO was that India needs to move faster in order for it to get richer before it gets older. Because for so long, we've been talking about our demographic advantage and our demographic dividend, but perhaps the time now is to focus on the fact that we're also fast becoming an aging population.
He's right. He's right. Within that construct, we'll have to see what is it that we can grow at. And as I said, 7 to 8%, aspirational 10% is, I think, a right number. Given all the governance structures we have in place, maybe in another economy where there were different governance structures, they could have grown at double digits and the low teens and the mid-teens. But we can't. Given our checks and balances, we need to grow at this pace to be stable. So I think the journey of Viksit Bharat 2047 to be developed is a very well articulated journey. And we can look at 2 stages in it, go from where we are to maybe 17 to 20 trillion, and then from there to the next step by 2047.
I also want to ask you, Mr. Kamath, about what you're seeing happen globally. There is, of course, a retreat from globalization, but there's also a retreat from multilateralism and from multilateral institutions. You were part of a multilateral institution. What do you believe that could potentially mean for the world and the rules of the game as we have come to understand them over the last many decades?
Multilateralism is not going away as such, because the next wave of handholding will be required across Africa. The multilateral institutions have been holding hands where the growth journey and the developmental journey could not be done by a nation on its own. 50 years back, we were in the same thing. Again, most of you probably were not born then.
We're not that young, sir.
How was I when ICICI was born in 1955? Most people would not have been here, would not have been there. How was ICICI funded initially? Through loans from the World Bank. Later on, it was loans from the German institution KfW. And later on, it was the Asian Development Bank, and then some government support to raise bonds. So this construct whereby the global north, as it were, supports the global south, I think will continue to be needed in several domains. Would it be needed in India in a big way? No, because I think we will graduate, but other countries will need. So in terms of the financial structure, financial architecture, certainly multilateral institutions will have a role to play. Will other multilateral institutions have a role? I think that's a question that will be asked as we go along.
You know, I want to end, Mr. Kamath, by asking you about something that I know you were deeply involved with, and you actually had numbers on your side, and that is the participation of women in the workforce, and you very successfully did that at ICICI Bank. As an economy, India cannot afford to not have women participate in the formal economy. We've seen a slight improvement in the metrics, but the journey is long. What is it that worries you on that front? But more importantly, what is it that you believe we need to focus on as a nation?
See, as a nation, if we keep to the target of growing at the pace we have been talking of, 7 to 8%, I think everybody will be mainstreamed, because that growth will not happen if there is only a lopsided employment that happens. The second was access to and the mindset to do what I'd call the sort of subjects that are relevant to today's India. That probably was absent a few years back. But today, I see women taking up STEM. There are more women graduating with the STEM courses than others. So, with the evolution that is now taking place, the new technologies and so on, I am equally sure that there will be more women, if not more equal number of women, who will take these courses as men. So, I would think that we will grow in what I like to call a gender-neutral way.
Well, that does deserve a round of applause. I hope we do grow in a more gender-neutral way. Mr. Kamath, if you were given the task of a headline that captures the spirit, the mood of India in 2025, as we look into 2026, what would it be?
I would simply say 10 trillion, here we come.
10 trillion is here we come.
Yes, here
10
we come,
trillion,
yes.
here we come.
Yes.
KV Kamath, always a pleasure. Ladies and gentlemen, a big round of applause for
Thank you, Shireen.
the veteran banker and the Perma Bull on India. Thank you very much for your time, sir.
Thank you, Mr. Kamath and Shireen, for that conversation. That was a comprehensive look at India's financial infrastructure and global positioning. And now let's drill down on one specific shift that's happening right away. India